The market didn't break. It flipped. For years, precious metals moved sideways, exhausting everyone watching. Slow rallies, long pullbacks, a constant tug of war that trained investors to expect disappointment. But that phase just ended. What looks like another price move is actually something more violent, a shift from accumulation into vertical repricing. Here's the contradiction. Silver spent half a century trapped between $4 and $50, a range so tight it felt permanent. Yet the moment price action became compressed and boring, momentum began accelerating. Corrections that once took months now resolve in days, sometimes hours. That's not calm, that's energy being forced into a smaller and smaller space. This matters to you because markets don't exit 50-year structures gently. When they break free, they don't retest for comfort. The $100 level isn't just resistance, it's a psychological fault line. Once it gives way, the move that follows won't feel logical. It will feel sudden, disorienting, and impossible to catch up with. But here's the part nobody is saying out loud. Silver isn't leading this move. It's being pushed. So the real question is this: what kind of force is powerful enough to snap a structure that held for generations? The trigger isn't in commodities, it's in the foundation they're priced on. What's unfolding now didn't start with silver or even with inflation. It started in the place markets rely on most and question the least: sovereign debt. Specifically, long-dated government bonds, the part of the system that's supposed to represent safety, stability, and time itself. Here's what matters. The long end stopped behaving. Yields didn't just rise. They lost discipline. Attempts to stabilize failed repeatedly. What should have been orderly recoveries turned into stalls, then breakdowns. That's not a normal cycle. That's loss of control. And notice how this was framed. Temporary volatility, technical factors, isolated stress. But none of those explanations address the core issue. Confidence didn't return. Duration risk wasn't absorbed. It was avoided. This isn't a one-off event. It's a pattern. When trust in long-term promises erodes, capital doesn't rebalance calmly. It rushes out of anything that depends on time and faith. And when that happens, assets tied to currency stability are forced to adjust, whether anyone wants them to or not. Here's the reframing question. If the asset that anchors the system is wobbling, what happens to assets that were deliberately held down to support it? Because that's where this story actually accelerates. The strongest signal isn't coming from prices. It's coming from behavior. For years, the system functioned because most participants were willing to accept paper promises instead of the real thing. Contracts traded, positions rolled, delivery was theoretical. That balance just cracked. Large holders began removing physical silver from exchange vaults, not trimming, not reallocating, withdrawing. Millions of ounces quietly left the system. That detail matters more than any chart. When institutions choose custody over liquidity, they're not speculating. They're insulating. And notice what didn't happen next. There was no clear reassurance that inventories were healthy. No firm statement that supply chains were intact. Just muted responses and procedural language. This is where the structure shows strain. Paper markets depend on confidence, not metal. They work only if most people never ask for delivery at the same time. The moment preference shifts from exposure to possession, leverage becomes a liability. Short positions can't unwind cleanly. Liquidity thins when it's needed most. Now watch how fast this escalates. A system built on fractional settlement only functions when belief stays abstract. Once that belief turns physical, control evaporates. And once that happens, price stops being negotiated. It starts being discovered. What comes next doesn't look like a crisis at first. It looks like adjustment. At first, the system absorbs the strain. Small delays are explained away. Inventory swings are labeled temporary. Volatility is treated as noise. This is how normalization works. not by fixing the problem, but by teaching participants to tolerate it. We've seen this pattern before. In past commodity shifts, pressure built slowly until supply failed visibly. But this time the order is reversed. Trust cracked first. And when trust goes, supply doesn't need to vanish to cause damage. It just needs to hesitate. That hesitation is already being normalized. Faster moves are no longer shocking. Shallow pullbacks are no longer reassuring. What should trigger concern is being reframed as efficiency. Markets adapt to instability instead of resolving it. This is where the story flips. When abnormal behavior becomes routine, systems stop dampening shocks. They amplify them. Each small disruption carries more force than the last. And once amplification replaces stabilization, the next phase doesn't arrive gradually. It arrives all at once. That's when the pressure you barely noticed becomes impossible to ignore. The next signal comes from inside the official machinery, not the fringes. Watch how large issuers are pricing risk. Government-backed silver products aren't being sold as if today's prices will hold. They're being priced as if replacement costs are going to be much higher. That gap between spot price and official pricing isn't random. It's defensive. It reflects expectations, not marketing. At the same time, refiners are changing behavior. Certain forms of silver are being refused. Payments that once cleared quickly now stretch into weeks, sometimes months. That's not demand destruction. That's capacity stress. When processors slow down during rising interest, it means the bottleneck isn't buyers, it's throughput. Here's the detail that changes how you see the market. If metal can't move smoothly through the system, price stops being the control mechanism. Time becomes the constraint. And when time replaces price, markets don't clear gradually. They gap. Notice the contradiction. Public messaging suggests stability. Operational behavior suggests caution. That split tells you where expectations really are. And once operational stress becomes visible, repricing stops being optional. It becomes mechanical. Now the stress begins to stack, quickly and quietly. Industrial demand doesn't wait for headlines. Manufacturers don't speculate. They secure inputs. Solar producers, tech manufacturers, and energy supply chains extend contracts and lock volumes because production halts without silver. Price sensitivity drops out of the equation. What matters is continuity. That removes supply long before the public notices. At the same time, processing delays ripple outward. Refiners slow, dealers can't turn inventory, capital gets trapped in transit, restocking cycles stretch. What used to be a fluid loop starts to stiffen, not from panic, but from timing mismatches that compound. Liquidity erosion doesn't announce itself with crashes. It shows up as hesitation, wider spreads, limited quotes, fewer options. Each friction seems small. Together they create pressure that can't be released smoothly. None of this feels dramatic in isolation. That's the danger. These forces reinforce each other quietly. Demand accelerates, supply lags, cash flow tightens, the system strains without breaking, and that brings us to the question that matters now. This is where the consequences stop living on balance sheets and start showing up in real life. When supply tightens and processing slows, the impact doesn't stay abstract. Availability changes first, then pricing behavior. Premiums widen, waiting replaces buying. What used to be a simple transaction becomes a process. You feel it not as panic, but as friction. That friction changes behavior. People stop asking whether something is cheap. They start asking whether it will still be accessible, not later. Now, that shift doesn't require ideology. It doesn't require belief. It only requires one delay, one missed order, one out of stock where there wasn't one before. And once access feels uncertain, trust migrates away from intermediaries, away from promises, toward possession, toward control. That's not fear-driven, it's rational under constraint. If this feels familiar, say so in the comments. Because when enough people experience the same friction at the same time, demand stops behaving predictably. It becomes defensive. And defensive demand doesn't wait for pullbacks. That's when pressure stops building quietly and starts expressing itself openly. What's actually driving this isn't emotion or speculation, it's structure. Systems behave differently when incentives flip. For decades, the precious metals market functioned because trust was outsourced. Settlement was abstract, exposure was enough. As long as intermediaries were believed to work, leverage could stretch without consequence. But that incentive is changing. When delivery risk rises, holding paper stops making sense. Institutions don't argue with narratives. They respond to mechanics. They reduce dependency. They move from claims to control, from promises to possession. This is why accumulation at the highest levels looks calm instead of frantic. Central actors aren't chasing upside, they're insulating against failure modes. They understand something rarely discussed. In system resets, access matters more than price. Here's the unsettling insight mainstream coverage avoids. Stability isn't restored by managing volatility. It's restored by restoring trust. And once trust migrates away from financial abstractions toward physical settlement, the old control tools lose effectiveness. That doesn't trigger an immediate collapse, it creates drift, then gaps, then sudden repricing events that appear to come out of nowhere. The system isn't breaking loudly, it's quietly reassigning power, and that sets up what comes next. From here, the future doesn't collapse into one outcome, it splits. In one path, pressure is released slowly, controls increase, friction becomes policy, access is managed more tightly than price, markets stay open but movement is constrained, volatility flares, then gets smoothed over. On the surface it looks like stabilization, underneath it's rationing by another name. In the other path, release comes suddenly, a delivery failure, a rule change, a settlement exception that can't be explained away. Confidence doesn't erode further, it snaps. And when that happens, price doesn't negotiate. It jumps. What looked expensive becomes irrelevant. Availability replaces valuation. Notice the common thread. In both paths, control weakens. The difference is speed. Either pressure bleeds out over time, or it vents violently in a single moment. But it doesn't disappear. That's why the next move already feels loaded. Markets aren't waiting for new information, they're waiting for permission. And when that permission appears, even briefly, repricing won't ask if it's justified. There's one idea that ties everything together. This was never just a metal story. It was a trust story. When trust holds, prices can be managed, delayed, explained away. When trust weakens, pricing stops being a debate and becomes a consequence. Assets don't suddenly become valuable, the system measuring them loses authority. For decades, stability came from believing someone else would always make the market function. That belief is quietly dissolving, not through panic, but through millions of small decisions to hold, withdraw, delay, or step outside the system. When enough of those decisions align, the outcome feels sudden, even if the cause was slow. So the real question isn't where silver or gold goes next. It's what happens to everything else when confidence breaks and reference points stop working. Because once a system starts repricing trust instead of assets, it doesn't rewind. It moves forward until a new equilibrium is forced into place. And this story isn't finished. The next phase goes beyond metals. If you want to understand what gets revalued next, stay with this channel.